Sorry, my yeah. Let me seize this opportunity to say Happy New Year to all of you and wish us a prosperous year. The Monetary Policy Committee held its first meeting for 2023 on the 23rd and 24th of January 2023, as optimism of a rebound in global output recovery waned considerably, giving room for increased concerns of a likely global recession in 2023. This is driven by several global shocks impacting negatively on growth and price development. Major headwinds to global growth include ongoing geopolitical tensions in some regions, intensified disruptions to the energy market, persisting supply bottlenecks, resurgence of the COVID-19 pandemic in major industrial cities in China, and tightening external financial conditions. In addition to these, the slow growth in global trade, continued volatility in the oil market, and growing private and public debt portfolios are clear signals of increasing uncertainty, imposing a drag on growth. Private and public debt portfolios are clear signals of increasing uncertainty, imposing a drag on growth. Private and public debt. In the domestic economy, output growth recovery was subdued in the third quarter of 2022, but expected to recover moderately in the fourth quarter on the back of continued support of both monetary and fiscal policy through various interventions in growth-enhancing sectors. At this meeting, the committee reviewed these and other developments in the global and domestic economic and financial environments in 2022, as well as the outlook and risks for 2023. 12 members of the committee attended this meeting yesterday and today. The global development. The committee noted with concern the growing evidence of increased militarization of the war in Ukraine and the consequence of a prolonged war on the recovery of the global economy. It also noted the renewed concern of the possibility of yet another pandemic reverberating the global economy in 2023 as infection rates rise in China following its lifting of COVID-19 restrictions. Two factors alongside the tightening of global financial conditions associated with the ongoing normalization of monetary policy in the advanced economies, economic growth. The combined impact of these shocks on the global economy could result in further disruptions to commodity and energy markets, as well as the efficient functioning of global supply chains. In the advanced economies, fiscal policy and markets and shock spillovers from the global economy. The International Monetary Fund, the IMF, 2022 World Economic Outlook retained its global output growth projection for 2022 at 3.2%, but was further downgraded in 2023 forecast to 2.7% compared with 2.9% in its July 2022 forecast. The World Bank in its latest forecast indicated a much lower growth expectation of 1.7% for 2023. On price development, the MPC observed that inflation in most advanced economies, although trending downwards, remains significantly above their long-run objectives and expected to remain elevated throughout 2023. High price of food and energy, a lagged impact of the massive liquidity to douse the impact of the COVID-19 pandemic, and persistent disruptions to the global supply chain as China faces a renewed surge of the pandemic. Fears that Russia may renege its commitment to the Black Sea grain deal is also building expectations of possible rise in medium-term price levels. In the emerging markets and developing economies, inflation is expected to moderate marginally in 2023, but remain broadly elevated due to a combination of factors such as the persisting high price of grains and other commodities, continued exchange rate pressures, and other legacy structural factors. In the global financial markets, the continued normalization of monetary policy has led to the tightening of external financial conditions and increased volatility in equities market. With the increased fears of a likely global recession in 2023, investors have commenced a move towards safe haven assets such as gold and silver to safeguard their portfolios. In the advanced economies, corporate debt levels remain considerably high as pressure builds to avoid default scenarios with the continued hike of monetary policy rates. In the emerging markets and developing economies, the persistence of rising public debt profiles and capital flow reversals are putting severe pressure on exchange rates, posing a challenge to external sustainability. Our domestic development. Available data from the National Bureau of Statistics reveal that real gross domestic product grew by 2.25% year-on-year during the third quarter of 2022, compared with 3.54% in the second quarter and 4.03% in the corresponding period of 2021. The economy has continued on a path of positive growth for 8 consecutive quarters. This is driven largely by the support by the bank and the fiscal authority to growth-enhancing sectors. Staff projections showed that output growth recovery is expected to continue reasonably in 2023, given the expected sustained positive performance during the fourth quarter of 2022 and steady rebound in economic activities. MPC welcomed the moderation in inflation following 10 consecutive months of uptick as headline inflation year-on-year declined marginally to 21.34% in December 2022 from 21.47% in November 2022. Month-on-month headline inflation, however, increased to 1.71% in December 2022 from 1.39% in the preceding month due to a rise in consumer spending during the festive period. The committee observed the continued growth in money supply with broad money M3 growth exceeding the 2022 provisional benchmark of 15.21% at 16.52% year to date in December 2022, compared with 13.92% in November of 2022. This was largely driven by increased claims on other sectors like other financial corporations, state and local governments, below and within the asymmetric corridor of the standing facilities corridor, reflecting changing liquidity conditions in the banking system. Accordingly, the monthly weighted average open buyback OBB rate decreased to 11.61% in December 2022 from 12.56% in November, while the monthly average interbank rate increased to 12.08% in December 2022 from 11.89% in November. The MPC noted the continued resilience of the banking system, evidenced by the progressive improvement in non-performing loans NPLs ratio from 4.9% in November 2022 to 4.2% in December of 2022. Committee also noted that the liquidity ratio was well above its prudential limit at 44.1%, while the capital adequacy ratio remained at. The equities market was bullish in the review period as the all-share index and market capitalization increased to 51,251 and 27.92 trillion naira on December 30th of 2022 from 43,839.08 and 23.88 trillion naira respectively on October 31, 2022. This reflected better than expected corporate earnings and improved investor confidence in the market. Committee noted the marginal decline in the external reserves as gross external reserves decreased by 0.95% at the end of December 2022 to $36.55 billion from $36.9 billion at the end of November 2022. This reflects the exchange rate pressure accentuated by a combination of heightened demand and slow accretion to reserves. Anchor Borrowers Program, the bank disbursed 41 billion naira to several agricultural projects, trillion naira, to over 4.6 million smallholder farmers cultivating or rearing 21 commodities across the country. The bank also released 300 million naira to finance large-scale agricultural projects under the Commercial Agricultural Credit Scheme (CACS), bringing total disbursements under the scheme to 745 billion naira for 680 projects in agro-production and agro-processing. In addition, the bank released a sum of 48.3 billion naira under its 1 trillion naira real sector facility to 7 new real sector projects in agriculture, manufacturing, and services. Cumulative disbursements under the real sector facility currently stands at 2.15 trillion naira, disbursed to 437 projects across the country, comprising 240 manufacturing, 91 in agriculture, 93 in services, and 13 mining sector projects. Furthermore, under the 100 for 100 policy on production and productivity, the bank has disbursed the sum of 20.78 billion naira to 9 projects in the healthcare, manufacturing, and services sectors. This brings the cumulative disbursements under the facility to 114.17 billion naira to 71 projects across manufacturing, agriculture, healthcare, and services. The bank released 4 billion naira under the intervention facility for the National Gas Expansion Program to promote the adoption of compressed natural gas as the preferred fuel for transportation and liquefied petroleum gas as the preferred cooking fuel. In the SME sector, the bank supported entrepreneurship development with the disbursement of a sum of 1.3 billion naira and 10 million naira under the Agribusiness Small and Medium Enterprise Scheme and Micro, Small and Medium Enterprise Development Fund, respectively, to support entrepreneurship development in the country, bringing total disbursements under the interventions to 150 billion naira and 96 billion naira, respectively, under the Export Facilitation Initiative. The bank export-oriented projects with a sum of 5.34 billion naira, bringing the cumulative disbursement under the intervention to 44.58 billion naira. The outlook. The broad outlook for the recovery of both the global and domestic economies remain uncertain, with the path to full recovery clouded by significant downside risks. The key risks remain the lingering headwinds from the Russian-Ukraine war, heightened inflationary pressures across several economies, and sharp slowdown of economic activities in China with the resurgence of COVID-19 pandemic across its major cities. Others include the tightening of external financial conditions as monetary policy normalization continues, increasing risk of a global debt crisis as both corporate and public debt levels burgeon, and rising risk of a global recession in 2023. Available data and forecasts for key macroeconomic indicators for Nigeria suggest that the economy will continue to grow through 2023, but at a subdued pace. The continued high level of insecurity, perennial scarcity of petroleum motor spirit PMS, and high cost of other energy sources, increased spending towards the 2023 general election, rising cost of debt servicing, and deteriorating fiscal balances remain the key sources of shocks to the Nigerian economy. Accordingly, the economy is forecast to grow in 2023 by 2.88% by the CBN estimate, 4.2% federal government estimate, and 3% by the IMF estimate. The committee's consideration. At this meeting, although the MPC was delighted that inflation year-on-year had started to moderate, it was not convinced that a marginal 13 basis points dip in inflation was enough to begin to celebrate. The committee was therefore not of the opinion that a hold or losing option was desirable. This is because loosening under a double-digit inflationary condition will be tantamount to an immediate reversal of the expected further downward trend in inflation. The committee also felt that loosening will negate the objective of dampening the pent-up aggregate demand that fueled the rise in inflation post-COVID-19 pandemic. As for hold, the committee was reluctant in considering this option because a hold option will signal MPC's quick adjustment of its policy stance due to a one-time marginal decline in inflation, suggesting a weak thrust in its previous policy stance at taming inflation. The MPC was therefore unanimous in its position to continue to tighten. However, the dilemma at this meeting was whether to continue tightening aggressively or moderately. To the committee, a moderate tightening may slow the rate of deceleration in inflation without necessarily hurting output. For those members who felt that an aggressive stance was needed, they were of the view that Nigeria's inflation at a rate above 20% was already a threat to growth and among the highest in the world. To this group of members, aggressively raising the policy rate was paramount to reining in inflation because an aggressive tightening stance will further narrow the negative real interest rate margin. MPC also feels that a tightening stance would signal confidence in the effectiveness of its monetary policy direction to rein in inflation, improve financial system stability, and moderate exchange rate. The committee's decision. Members welcomed the recent deceleration in year-on-year headline inflation, noting that the persistence in policy rate hikes over the last few meetings of the committee has started to yield the expected decline in inflation. The committee thus deliberated on either to hike rates further or hold for the impact of the last 4 rate hikes to continue to feed through. At this MPC, therefore, the options considered were primarily to hold the policy rate or tighten further to consolidate the gains of previous rate hikes. Loosening in the view of members would gravely undermine the gains of the last 4 rate hikes. MPC noted the continued upward risks to price development characterized by the forthcoming 2023 general elections, perennial scarcity of PMS, continuing rise in other energy prices, exchange rate pressures, as well as rising insecurity. Members, however, noted that the current Naira redesign and cash withdrawal limits policies are huge moderating factors to price development as currency outside banks is expected to continue to moderate beyond the implementation stage of these policies. MPC was of the view that although inflation rate moderated marginally in December, the economy remained confronted with the risk of high inflation with adverse consequences on the general standard of living. The committee therefore decided to sustain the current stance of policy at this point in time to further rein in inflation aggressively. 1 member voted to increase the MPR by 150 basis points, 4 members by 50 basis points, and 7 members by 100 basis points. In summary, MPC voted to 1, raise MPR to 17.5%, 2, retain the asymmetric corridor at plus 100 and minus 700 basis points around the corridor, and 3, retain the CRR at 2.5%, and 4, retain the liquidity ratio at 30%. I thank you for your attention.
Thank you, Governor. And that was communique number 126 of the 289th meeting of the Monetary Policy Committee of the Central Bank of Nigeria, and was considered to be first for the year 2023. And we shall be taking some questions from the press. And as is usual, tell us your name, the media house you represent, and your question. Thank you.
Good afternoon, Mr. Governor. My name is Ndoka Chase, the Affiliation Newspaper. Mr. Governor, sir, after many months of upward trajectory, inflation is to 21.34% as of December 2022. To you, is this a positive enough sign?
Hold on. There is interference.
His phone is he's here.
Go ahead.
So is this a positive?
Try. Just try.
Is a positive development in the future? Thank you very much.
Thank you.
Good afternoon, Mr. Governor. My name is Bjorn Gary from Kogi, Nigeria. According to the banks, the old 200, 500, and 1,000 notes will cease to be legal tender from next week Tuesday. Last week, your staff were all out on compliance drive. And one of the issues that came up was the request for an extension owing to reasons they highlighted, including difficulty in accessing the new ones. What do you say to this request?
Thank you.
Governor, my name is Isa Boha from Telegraph Newspaper. Currency design. What percentage of currency outside bank vaults has come into CBN? And in analyzing your policies, do you think it favors ordinary Nigerians?
Good afternoon, Mr. Governor. My name is Tia Babatunde from the Nigerian Television Authority. I have two questions for you. The first is the debate around the Ways and Means Forum, which the National Assembly is already trying to intervene for sort of chats on chores. Can you provide us with a form of clarification on what the true picture is? And secondly is another issue that has been in the news, stamp duties. If you could give us an update on it. Thank you.
Okay, Governor, the final one from Lagos. All right. From Nume, Kenya, these days newspapers. With the CBN championing the use of alternative payment channels, such as the e-Naira, POS, among others, what is the bank doing in collaboration with deposit money banks to ensure the safety of depositors' funds in the face of renewed efforts by fraudsters to breach the accounts of unsuspecting bank customers? Thank you, Lord.
Well, thank you very much. The first question says that that we've seen inflation dropping for the first time in almost about 10, 11 months to about 31.34% by December, and whether this is a positive enough sign for us to expect inflation to trend lower in the coming months. Our response here is that yes, we are happy that some of the policies that we've introduced in the last couple of months in our attempt to rein in inflation are beginning to yield results. Not just about plateauing, but also beginning to drop. But Monetary Policy Committee members feel that a 10 basis points drop from 21.47% to 21.34% is just not good enough as a reason to begin to celebrate. That's it. But on the basis of CPI, we still found out that inflation was still going up, both the headline and all that. On year basis, we saw food coming down, but at the same time, we still saw core inflation moving up. For us, it is not time to celebrate yet. MPC believes that, and you could see from the communique I read, we said, of course, loosening, and we use the word in the meeting, throw loosening into the Atlantic Ocean. Hold, well, keep it in the dustbin and let's watch. But of course, for now, it is tightening. The issue, therefore, was, to what extent should we tighten? Should we begin to say because inflation had begun to trend downwards that we should moderate the rate of tightening? Or that, listen, this is not enough sign and that we should remain aggressive? If you recall, rates were aggressive in 2022 for the last 4 meetings. The first one was 100 basis points, the second one 150 basis points, the third 100, and the fourth another 100. But those who felt that there is a need for us to remain aggressive felt that with inflation at 21.34%, it's already hurting growth and is moderating the level of output that we would have seen if inflation was within our own target range. You know, these days we have not even been able to talk about a target between 7 and 10%. And at 21.4, there was no how inflation, we can begin to celebrate that inflation at 21.34% is good enough for us to begin to taper and the rest of them. So that's why you would see that the meeting was divided into two. Those who felt moderate the rate of increase so as to continue to, so that you don't create more problem for output, whereas those who felt increase aggressively feels that output is already being hurt. Anyway, at 3% or sub 3%, output is already being hurt, given every effort that both the monetary and fiscal authorities were putting in place to drive growth. So we might as well push aggressively to push inflation down so that when it comes to the level that we are comfortable with, we can begin to either moderate the rate of increase or begin to think of either holding or loosening. So that's the thinking of the members. And that's why we're saying, yes, we are happy that the inflation rate has started to moderate year on year, but the other underlying numbers that we see behind does not give us cause to really celebrate. And for that reason, we are going to remain aggressive on rates. Now, the second question talked about the Naira design. It says, reports suggest that many people want the deadline to be shifted for reasons ranging from their inability to gain access to the new notes or deposit their old currencies. I must say here that unfortunately, I don't have good news for those who feel that we should shift the deadline. My apologies. The reason is because, just like the president had said on more than 2 occasions, and even to people privately, that for us, 90 days, in fact, we feel is 100 days is enough for anybody who has money or the old currency to deposit it, the money in the banks. And we took every measure to ensure that all the banks were open or remain still open to receive all old currencies. 100 days, we believe, is more than adequate. We called on the banks. We said, not only are we requesting you to extend your banking hours so that you can receive old currencies? But we're also asking you to keep your doors open on Saturdays. Ladies and gentlemen, the banks did not have any reason to even keep their banking halls open on Saturdays. Neither did they see the kind of rush that they anticipated. Oh, there were normal people who came in to deposit money into the banks. And maybe in the course of time, I'll also give you details about how much had come in. So we do not see any reason to begin to talk about a shift because people could not deposit their old monies into their banks. Now, about the circulation of the new currencies, we said to ourselves, the currencies are available. We hold at least 3 meetings every week with the banks. When we first started, we saw that the banks were paying more of their money, more of the new currencies over the counter to their priority customers, rather than giving it to even some of the weak and small customers, or those who can call the vulnerable customers. We mandated them. We said, no, from now on, don't make any payment of new notes over your counter, which gives the opportunity for you to give in to your friends. Pay all new notes into your ATM. The ATM is a robot. Everybody queues. And then you take, whether it's 10,000 or 20,000 or 30,000 that is programmed, everybody collects the same amount. That has worked. At the initial stages, yes, because some may say that they were collecting new and old notes from the ATMs. At the initial stages, we told the banks, just feed your machines in the morning with the new notes. When it finishes, so that people don't complain that they don't have currency, put old notes, right, so that you can to serve customers. I say, okay, now